Hey guys, welcome back to another video. Today we are going to be talking about trading the indices and going through some technical indicators that might broaden your horizons on how to view the technical side of things more comprehensively. Now, indicators have a wide following. Some people like momentum indicators, they like oscillators, they like all sorts of different things. But today I'm going to show you a couple of my favorite things to consider looking through if you are a technical trader looking at indices. Let's get started. Also, if you're somebody outside of the US, I wanted to mention today's video sponsor, Vantage. Vantage Markets allows traders who are, again, outside of the US only. Unfortunately for US traders, CFDs are not available to us, but CFDs for traders outside of the United States allow you to trade things like the S&P 500, the NASDAQ, the Dow Jones, the Russell 2000, and so much more, all under a single broker like Vantage. Vantage allows traders to trade with all sorts of different indices. You can trade US indices, abroad indices, the Japanese stock market, the German stock market, and so much more. They also have a great welcome bonus available down below if you use the link in the description. You can find out more information about what they offer, do your due diligence, and see if it's the right broker for you. Now back to the video. So when you're looking at indices, there are all sorts of different indicators that you can use. Some of the more simple traditional ones are things like moving averages or the RSI, but today I'm going to tell you about a couple extra ones that I think are fun to look at and may actually be useful in spotting opportunities. The first indicator we're going to play around with is the Williams %R indicator, and this can be found on TradingView. If you just go to indicators and search up Williams %, you'll see there is the percent range. So the Williams % range indicator is similar to the RSI, but basically what this thing is doing is trying to help traders spot potential points in the chart where things are becoming overbought or oversold. But there are some specific ways that I like to use things like oscillators if and when I use them in my own trading. I'm looking for times where we are in a clear upward trend. So technically, I actually think that you need a couple indicators to make this one worthwhile. And the really simple one that I want to add on here is a moving average, and I'm going to just change the variables here. So before we can get into the Williams R, let me just do this with the indicator here. Let's just say we are looking at a 50-period moving average, and this is going to be what we would call our trend filter. So what I mean by that is that we are only going to be looking for longs in an uptrend or shorts if the market is in a downtrend. That's the first half. The second half is a really simple approach. In uptrends, we are going to look for oversold readings on the Williams %R. And in downtrends, we'll look for overbought readings. So what we can see here is that we can start plotting a couple of the examples at which point this indicator would have told us to potentially look at longs. So a long signal was produced right here, and let's see if there was any more, and there's no more. And by the way, if I go to the variables here or the inputs here, I'm just using the standard 14 length, and you can check all of my symbols or my different indicator selections here. So what you can see here is that although it didn't produce a ton of entries, this one entry that was produced was actually quite a good one. We were in an uptrend, we pulled back, the Williams % R gave us a nice reading there, and it actually produced a nice signal to the upside. Now, the reason I point this out is because in downward trends, if we were to take the oversold readings, you can see that those were not particularly the best entries. Now, this was technically a losing trade right here, as if I take this right here, and let's say that is where we first got an oversold reading in an uptrend. That ended up being a poor reading. However, let's take a look at the next reading. You can say, well, were we oversold here? Yes, but we are in a downtrend according to our 50-day moving average filter. But what about right here? Were we above the moving average? Yes, so we can't take that trade, can't take that trade, can't take that trade. But let's see if this one, nope, not quite. So we just barely missed that entry idea. But here is one that actually met our criteria. We're in a downward trend, and you can see the timing here was right around here. We got an overbought reading in a downward trend, and that signal was actually quite good. Now, the next indicator that I'm going to show you is something specific to day traders. Now, I'll show you why in just a second, but what we're going to pull up is the Sessions on Chart by AUROX AIF, and I've used this indicator for years in some of my video tutorials. So check this out. If I go Sessions on Chart, what you'll see is it immediately draws a bunch of colorful things here. And the reason I show you this is that if we break it down to a 15-minute chart here and we go into the parameters of this, what this indicator is showing us is the different London, New York, and Tokyo sessions that, and Sydney session that will show you when each market is live. And what I mean by that is that, markets of course have times where they're active and times where they're inactive. When, New Yorkers are asleep, they're not going to be trading. When London people are waking up, they're going to be trading. So this sessions on chart is a very simple indicator that will allow day traders to spot times in the market where volatility is going to be highest. So I just want to show you this as an example, because if we take a look, you can change all the different colors to your liking, but you can see here that once the London and New York session overlapped, which is this kind of dark shaded brown, that is traditionally where you get the biggest amount of volatility in the market. Now, the red only is going to be the New York session. The kind of green only is the London session. So you can break this down by session, which is very nice because it gives you an idea of when, volatility is likely to be happening, and more dead space times when things are not expected to move very much. And this can make trading indices a lot better because you're trading during the sessions when they're active, not waiting around for price to do anything if you're trading the wrong time. The last indicator I'm going to show you is the ATR, or the average true range. You can search this one up in your indicators. I have it favorited for a reason. I find this indicator to be very useful for when you're trying to place more importantly placed stop losses. Now, if you've done trading for any amount of time, you know that a stop loss placement is very important. And a better stop loss can be potentially found by using the average true range. Now, the average true range creates this line that goes across your screen. And the big question here is, what does this do and what is this telling us? It's not actually a very important indicator for timing the market or finding entries or exits, but rather it helps you find distances for stop losses. And this is very important. So right now, the way to read this is that we are getting if we could zoom in on this number right here in the edit, what we can see is that we're getting an 84.77 reading on the average true range. And what that's telling us is that the average true range of each bar, in this case a daily move because we're on the daily chart, is about 84 points here. So you can see an 85 points would be about this much to the upside, 85 to the downside would look about like this. So when we're placing a stop loss, we may want to consider placing our stop loss outside of that normal range distance that we're calculating. Now again, this is taking a look, this line is produced by taking a look at a 14 period look back. You can increase or decrease this. If you increase this to, let's say 200 as an example, it's going to give you a long-term average daily range for the S&P 500. So the long term of the 200-day look back period is about 61 points. So again, that's something to consider when placing your stop loss. You might not want to put your stop loss in a very normal daily range, because then you might just get whipped out on a normal intraday movement. Whereas if you are, trying to place a more intelligent stop loss, you may want to put it beyond that 61. Let's just say, for example, you put it at a 70 or 75 to give yourself a little bit of room in case that stop loss wants to get tested. You don't want to get whipped out. So the ATR, the average true range, can be a wonderful indicator for getting an idea of what is a normal range for price to move in, so that you don't get whipped out preemptively on trades as much. I hope this video was helpful to you. Remember that if you're not already trading with a broker that allows you to trade CFDs and you're outside of the US, consider using Vantage. Using the link down below in the description, there's a really nice sign-on bonus available to you. Thank you very much for watching. Thanks for watching this video, and on the screen right now, you'll see some other options of other videos we put together that might be helpful to you in your trading career. So thanks for watching, and we'll see you next time.